There we go. Okay, I wanted to clean that up a little bit. All right. So Earl's first question, which we already touched upon a little bit in this case, is please explain a synthetic collar. Okay. Synthetic collar to me can mean one of three things, actually. I'm just going to go to our custom spread tool. And this is where we just build our positions on the fly. Since we were looking at it earlier, and we may relate back to it and back to the slides, I'm going to stick with KMB, Kimberly-Clark, as our example for today. I'm going to stick with standard September expiration, Earl. And if I was going to open a standard collar, what I would likely do is buy shares of stock. I'm going to give myself some room. I like this 140 call at 205 because volatility increased. The 139 looks good too. But the stock's still bouncing around at 137.50. So I'm going to sell the 140 call and buy the 130 put. It's probably too wide for me. I'd like to do the 135, but that's not done at a credit. So I'm going to go with the 130 so I get a credit. And what do I mean by too wide for me? Is I think the risk on this particular collar is going to be beyond what I want to see. But in any case, we're going to buy and we're going to sell. Selling slightly out of the money, 140, buying it deep out of the money, 130. Oh, it's not bad. It's not as bad as I thought. All right, so in this structure here, I'm getting 213 for the call. Now, market moved again. So 1.5 out of the money, I'm getting 213. I'm only paying about $1 for the 130 put. My maximum risk is 724 or 5.3%. A little bit higher than I'd like, and the return is at 2. A little bit lower than I like. I'll be honest with you. The structure I look for collars is I'm going to look for about a 2.5% return if assigned or higher, and at the same time only carry a risk of maybe about 4.7%, maybe 5. So about a 2-to-1 risk-reward ratio. This is my synthetic collar. This is my standard collar, Earl. Stock moves up, I get assigned on the call, I make 2%. I'm wrong, the stock falls, I'm going to be at around a 5.3% loss in the position. And this is with the 140 and the 130 call. Now, I'm sorry, investment, I got to jot this down while I'm here. The investment amount is $13,723. That includes the price of the stock, premium from the call, and price for the put. No monetary requirements needed, guaranteed to get 13,000 back. So the risk is 724, 5.3%. Max return is 276 or 2%. Now, the truest definition of a synthetic collar would be instead of buying the stock, selling the call, and buying the put, we're going to do a synthetic stock position, which is what? Well, naturally, we are going to buy an at the money, in this case we'll call it the 138 call, and we're going to sell a 138 put. Okay, so we're going to add 2 more legs, keeping the same expiration in this case. So I'm going to buy a 138 call at $3, $3.10, sell the 138 at about $3.40, $3.50, get another little net credit into this as well. Okay, so this is your synthetic stock position, selling a put and buying a call. I still have the other 2 legs there as well to complete the collar. It's a 4-leg options trade. And looks very similar, doesn't it? The profit and loss chart is skewed because of, it's just skewed because it's doing a tighter map, but that's okay. So what did I just do? My original risk on the standard collar in this case was $726. Why is this lower? Well, it's because that extra 45 cent net credit we got from this transaction, the synthetic stock position at a credit of about 35 cents. The return goes higher. It was 275, 276. Okay, so that goes up a little bit more. Why? Because of the credit received, and of course because of the fact that the call is going to also increase in value in addition to losing the value on the short call, and we keep the premium from the short put. Okay, the monetary risk shows at 647. That's very interesting, but also very true. I'm going to quickly take out the first portion of our options trade, I'm going to take out the September 130 put and the September 140 call, just to show for the fact that here is our synthetic stock. I'm using the 138, which is 41 cents in the money for the call and 41 cents out of the money for the put. But there's your synthetic stock position. By itself, you'd still have to put up the margin requirement to what? Cover the naked put. In the synthetic stock position, the right to buy shares of stock at 138 does not cover the obligation you have of selling the 138 put, where you may have to buy shares of stock. So we'd have to put up the cash secured amount, and if you're trading on margin, you might only have to put up 50% of it. Now, let me add back in our September 130 put. What does this do? Now, instead of being in a naked put, I can see this, my broker will see this as a bull put credit spread at 138 and 130. I only have to cover the $800 margin requirement between the strikes. And I sell the 140 call back. What's this? That is a bull call debit spread at 138 buy, 140 sell, and a bull put credit spread at a 130 buy, I know it's opposite, but a 138 sell. So I need the 8 points margin here. I have a debit here, but I countered that by taking in 330 of premium, 205 in premium, even though I paid here and I paid here. So that's how the math works. It's a synthetic collar, but you just combined, how do I want to phrase this, an at-the-money bull put credit spread with an out-of-the-money bull call debit spread. That's what it is. That is your synthetic collar. We reduce the monetary risk from the new premium received, assuming, this is assuming that you get into the synthetic position, buying the 138 call and selling the 138 put at a credit. If it was at a debit, the risk would go higher than what we originally saw in the collar. And of course, we increase the profit, and we have a margin return because everything is covered as a credit spread or a debit spread. That's your synthetic collar. We complicated it with 4 options transactions to get the same thing, again, with the benefit of lowering the monetary requirement, lowering the max risk, and increasing the return, under the assumption that your synthetic stock leg was entered at a credit. Okay. Now, we could also comment that the synthetic collar is one other thing, isn't it? This return here, oh, I got to jot this down. Our synthetic would be 648 risk, which is 100% of what we invested. Important point. It would take me $13,000 to enter the standard collar with buying the stock, selling the out-of-the-money call, and buying the out-of-the-money put. Here I have a leverage risk because of the options where my requirement or my max risk is only 648. What I don't want to do in this scenario is enter into 20 contracts, 19 contracts, because I have the $13,000 to spend. Because here, let me clear that up, you are risking 100% of this 648 obligation. So if you increase that to 20 contracts, you have the $13,000 to spend, you're not risking the 648, you're not risking the 726, you're risking the 13,000. You could lose that if the stock fell below 130. Okay, so always keep that in mind. Be disciplined. Now, we see the structure here. We saw the structure of the initial collar. Risk-reward profile looks the same. Here we've got a little bit more benefit. But at the same time, 648 and 352 on the leverage position, that's 100 to 54. If I just used 2 options, and the bottom's at 130, okay, so I use 2 options, same expiration, I buy the expensive 130 call, and I sell the 138. I do a bull call debit spread. Now I pay a debit of $585. That's a lower monetary risk in this case than we saw with the synthetic, isn't it? And I didn't need 4 options to do it. But the maximum return is slightly lower because I didn't get the extra benefit of the credit from the synthetic stock position. It's a trade-off. Same risk-reward profile, but I'm only risking 585 instead of 648 on the synthetic or 724 on the standard collar with the same strikes. I'm looking to make 215, which is lower than the other two, but it's still a 36.8% return. Different ways, different folks. And we could analyze an at-the-money bull put credit spread as well. If we got filled at midpoint, that would be the same thing. So the synthetic collar is doing the synthetic stock first and then still doing the short call and the long put that you were planning on for the collar as well. And then in this case, what we're also looking at is you could also do it as a bull call debit or as a bull put, okay? All right, so we can cover that as well. Earl asked, could I get a copy of that slide? Of course you can. Email me the copy of which slides you wanted. I don't know what time you were asking that, but this is recording. Today's webinar all this is recorded. I'm going to post it. I'm going to split it up first. We're going to take Paul's first segment out. We're going to do this segment. We might do 2 or 3 other segments as well. Keeping with your segment, I want to address your second question now. And yes, Daryl, you're coming up, and Fernando, you are coming up right after Earl's second question. And Fernando's question is fairly easy to answer, so we'll get to that. And then Daryl's question is a little bit more in-depth on analysis, and that's fine. I had actually Earl's second question, and we've already gone through this. Okay, let's go through it again now that we're here. This isn't a spread I would particularly choose to be a vertical spread. Okay, and why do I say that? The return is fantastic at 36.8%, but if I'm doing a slightly in-the-money bull call debit, or the parity trade, the out-of-the-money bull put credit spread, I'm looking deeper out of the money to keep with a probability of about 85%. I'm going to look to be probably 4% out of the money or more, want an 85% probability, so I'm likely trading the 135 and maybe buying the 130. I'd only probably get that 14 or 15% return, but I've got an 85% probability. This is probably sitting here at 55% chance the stock will be above my short call or short put strike price, and I get the max return. That being said, looking at this, here's a debit spread that could be successful for a 36.8% return. The 130-138 split. Again, not a structure I would use for a credit or a debit spread, really a credit spread, excuse me. I might do this on a debit spread. It's a different story. We have a debit of 585 for a max return of 215 or 36.8%. I'd have to pay the debit into the position out of my account and then close it. I have to actively close this bull call debit spread at expiration or beforehand. If I've hit my profit target prior to expiration, what do I have to do? I have to sell to close my long and buy to close my short to get close to that $2 or $8 in this case, excuse me, difference in strike prices back. If I legged in and legged out of this position, that would be 4 commissions round trip. Buy to open, sell to close, sell to open, buy to close. Okay, it's 4 round trips. If your broker charges you a spread commission, then you might only pay 1.5 commissions instead of paying $7.95, or let's say your commission is $7.95 and you're thinking you're going to have to pay $15 to open this spread, or let's say $5.95 or $12 to open this spread for 2 legs, but they only charge you $8.50, you get a little bit of break there. But to get the return, you either have to actively close it and pay another 2 options commissions, or the break. If they give you a break, you might be able to close it for $8.50. Or even if you hold it through expiration, what happens? Well, you have to deliver shares of stock you don't own, so your broker's going to exercise your long option to deliver the short. They might just charge a stock commission for this, or they might actually charge you an option commission action for exercising and a stock commission because you're selling to close stock. It gets kind of tricky. But either way, I have to do some form of another 1 or 2 commissions to close this trade out to get my maximum profit. Whether it's before expiration, I leave it through expiration. A parity trade, of course, to that structure would be doing the bull put credit spread by selling our 138 put, again we saw that at about 345, buying the 130 at about 95 cents to $1. Same similar profit and loss chart, similar risk-reward profile, but now I'm looking to make 250 instead of 215. And my risk is only 550 in this case as opposed to 585. So here to me is a winner. I'd be more, if this was the spread I wanted, I'd much rather take this bull put credit spread with a potential return of 45.5. Your direct question was, please explain why credit spreads are so much more popular than debit spreads. Not every bull put credit spread will have a better risk return than its comparable or parity bull call debit spread. That's true. This is an example where we see it. It's obvious. I would do the bull put credit spread. Same thing happens. If the stock stays above 138 in either trade, I make the full profit. If it drops below 130, I make the full loss on the trade. Why are credits more popular than debits? One answer is obvious. The same reason why I fight for years to tell investors that the married put structure we use at Radioactive Trading is the only structure where you can actually be right about 50% of the time and still make money. Because no one wants to buy stock and buy a put. They say, why are you wasting money on the put? Sell a call and get premium in. Don't pay money for the put. Well, it's because when I do that, just like your collar, I only have a 4 or 5% risk, not even related to a stop order, and upside potential beyond a covered call trade. Okay, that's just basic math and basic risk-reward tolerance. Okay, but I fight the fight even when I see that long-term you can be more successful sometimes in good markets with the bull put than you would ever be in a covered call trading plan. But we want premium in, don't we? And yeah, I trade bull put credit spreads with 15%, 20% of my portfolio. I like to see the credit coming in. There's nothing wrong with the debit spread, but that's why they're more popular. People want to see income coming in. A second reason why they're more popular is I only need, if I'm right, I only need that first or that 1.5 or 2 commissions. I just have to open this. If it does what I want, rather than having to actively close the debit spread, and same with the bear put debit, it just expires worthless. We keep the maximum profit. Okay, so the reasons why is 1, credit in. 2 is lower commissions to get the maximum profit. A third way that I cheat on, you've seen there are webinars on PowerOptions that talk about my 8 ways to manage a bull put credit spread. There's another webinar that's the 7 preferred ways to manage a credit or a debit spread. Why is there only 7 for a debit spread when there's 8 for a credit spread? This is my bull put. What do I want? Stock to stay the same or move up. I sold this put and I bought this put. In the bull call, I would have sold this call and bought this call. Parity trade. The stock starts to fall and my sentiment changes. One of the management techniques I have in the bull put is I can buy to close the short, which might be expensive. But if my sentiment is this stock or the market is wrong and it's going to continue down for the next 10, 15, 20 days, I leave the long open. Because as the stock continues down, the put continues to gain in price and it might counter the buyback cost I had, on that short put position. If I'm in a debit spread, a bull call debit spread, and the stock starts to fall, well, if I buy to close the short, that's fine, but I don't want to leave the long open because as the stock continues down, this is losing value too. I'd want to get out of both right away. Buying the short to leave the long open is not a management technique you can use with a debit spread, but you can with a credit spread. So 8 versus 7, but there's dozens of ways you could analyze to manage a debit spread. The 8 ways to manage the credit spread are my preferred ones that don't get overcomplicated. And for the debit spread, it's only 7. You lose 1. Number 4, and it's a little tricky and it doesn't apply to every stock. And I may have to erase the drawings here, but 1, 2, 3, 4. 1 is they get the credit up front. We see income coming in. 2, lower commissions. 3, an extra way to manage the credit spread over the debit spread if it starts to move against you. And I am going to erase the drawings, but I'll jot these back down again in one moment. I didn't even see if Kimberly-Clark was like this. Yeah, it was like this here. But let's go to September series again. What's another reason why debit spreads are harder? And ours is not too bad. The one we're looking at, here and here. I'm going to buy this and I want to get the best price for it. I always use midpoint when I enter my vertical spreads, Earl, to start. And if I have to move it or adjust it because I'm not getting filled at midpoint, that's fine. When you go deeper in the money, you kind of start to see wider bid-ask spreads on the in-the-money options. At the money, we're looking at a 30-cent bid-ask spread here and 20 cents. That's true. But let's say I wanted to go with that higher probability trade I mentioned. I wanted to go for a 75, 80% probability. I'm sorry, I might be selling the 132 strike. Oh, and let's just say going with the 127. This is a 20-cent bid-ask spread. I'd very likely be filled at 60 cents if I was buying the 127 put. This is a $1.70 bid-ask spread for the deeper in the money call. I can't guarantee that the market maker is going to give me 85 cents to the tune of $11.25. He's probably going to be forcing it close to 10.60. I'm sorry, the other direction. He's probably going to be forcing it closer to 11.60, 11.70 maybe, because it's a wider bid-ask spread. The 132, we've got a 90-cent bid-ask spread with the in-the-money call. We've got a 15-cent bid-ask spread with the out-of-the-money 132 put. So you've got a better likelihood of getting filled in these deeper out-of-the-money, over here deeper in-the-money positions at midpoint for favorable pricing on the bull puts than you do on the bull calls. So those are the 4 reasons I think investors prefer the credit over the debit. 1, it's obvious. Credit in, seeing a credit come into my account. Everyone likes premium generation. Even though they're parity trades, they have the same outcome. If the stock is at X or at Y at expiration, we want to see the credit coming in. Makes me feel safe. I did something useful, I generated in. I did something useful for my boss, I got paid money now. Okay? Lower commission rates. And of course, yep, a lot of that is being countered. There are services out there that are offering no commission trades. You've got Robinhood, of course, and a couple of others. Number 3, the extra management technique. That's my personal preference in that case. And of course, number 4 is easier to get filled at the midpoint with the out-of-the-money puts as opposed to the deep in-the-money calls if you're looking at that structure. Okay? That's the best way I can answer why investors as a whole feel it's better credit spreads or debit spreads. Before I move on to our other questions, let me just show you one quick feature on PowerOptions that a lot of our spread traders love. It is called the Spread Chain.
Now on PowerOptions, you can access the Spread Chain through multiple ways. You can go into the Tools menu for any vertical spread and click on Spread Chain. Or you can go to the Signature Tools tab and again, click on Spread Chain. Now what this tool does is it allows us to put in a stock symbol. Let's go ahead and stay with our KMB stock. And then we can put in certain criteria of what we want to see for spread width. Let's just go to 5 points. Minimum net credit or maximum return in the case of a debit spread. Let's put in 25 cents. Out of the money range, leave that at 1%. Minimum return, let's just call that 5%. And of course, the probability range that we want to see, let's call it greater than 70 for now. So in any case, we'll take KMB and we'll do that. Now, it defaulted to the September 13th expiration. I'm going to take that out. We'll go to the standard September 20th. Now, this is the credit spread view. See up here, we're in the credit spread tab, so it's showing me the bear call credit spreads that match my criteria on the left. There's only 2 of them. And the bull put credit spreads at midpoint, which match my criteria that we just input into those 5 boxes over here on the right-hand side. So we have multiple put credit spreads that match the criteria more than the call credit spreads. But what we were just talking about is credits versus debits. And one of the features on this tool, of course, is that I can click on the put credit and call debit parity or call credit and put debit parity. So let's take a look at put credit and call debit parity. I'm going to change my criteria again. We're going to keep the same expiration. Let's lower this probability down to 75 to 98, for example. Minimum return, we'll just put in 10% this time. Okay, so let's submit that. So here we see the combination on the right of the bull put credit spreads. And on the left, we have the bull call debit spreads. Let's take a look at the middle here, the 82.7% probability, which would be the same the theoretical probability in this case that the stock would be trading above 133. For the bull put, we'd sell the 133 strike and buy the 128. We'd get a net credit of 65 cents, which on our 5-point spread is going to be a return of 14.9% with an 82.7% theoretical probability. Over on the left, it's the same structure, but we're using calls. So we're going to sell an in-the-money 133 call and buy a deeper in-the-money 128 call. The debit here would be 455, which means if I do get the 5 points back at expiration, assuming the stock's trading above both strike prices, we'll get the 5 points back for a total profit of 45 cents against the 455 debit. That's only a 9.9% return. So in this case, I'd save commissions by using the bull put credit spread, and if I got filled at midpoint for the 65 cents, I'd get a much higher return, 5% higher return with the same probability and the same risk reward because these are parity trades. Now let's take a look. If I just click the plus sign here next to the bull put credit, let's go ahead and allow that in. There we go. You see the midpoint here for the option we're buying is 40 to 50. It's a midpoint of 45 cents. I'm likely to get filled at that price. The 133 put would be selling. I've got a bid of 105, an ask of 115. I'm probably very likely to get this midpoint of 110 with the cost midpoint of 45. There's my 65-cent net credit. Now, as we were just discussing, number 4 reason why investors might prefer the credit spread to the debit spread when we're looking at this high probability in the money bull call debit spread versus out of the money bull put credit spread with the same strikes. Now, this isn't as bad as I thought. The sell option 133, the bid is 740, the ask is 770. Well, it's 30 cents, but I probably could get close to that midpoint of 755. And we've got a 50-cent bid-ask spread on the buy option, the 128. So this isn't very wide, but at the same time, I'm not sure that I can guarantee it's only going to cost me $12.15 to buy this position. The market maker might force me to go higher. He might force me to go to $12.20 or $12.30. This is the buy option. So what's that going to do? That's going to increase my debit even more and even lower that maximum return I was looking for. And then again, of course, remember, to get that full profit on the debit spread, I'd have to pay extra commissions to actually close out the 128, 133 strikes to get the 5 points back, or pay a stock commission depending on how your broker handles it. On the put side, in this example, with the better net credit, the higher return with the same probability and using the same strikes, I don't have to pay that extra commission. It just expires worthless. Now, at times, you may see a parity here on the spread chain tool where the debit spread might be 3 or 4 points higher, 3 or 4 percentage points higher return than the bull credit spread. It might even be 5 or 6. You want to make sure you check that bid-ask spread, because if it's giving you a really favorable midpoint for the sell, but you've got $1.50, $1.60, maybe a $2 spread, it's going to be much harder to get filled at midpoint to achieve the debit that you want to get the higher return than the bull put credit spread. So it's just something you always want to compare. This tool makes it really easy for you to do if you're thinking about trading bull puts and say, you know what is the bull call debit spread offering me? Why not check it out? Or you're doing an in-the-money bull call. You say, well, let me see what the bull put's doing for me here. This out-of-the-money bull put, can I get more bang for my buck on the bull put side with the exact same structure, risk-reward tolerance, and probability? If the answer is yes, you might be very tempted to go with the bull put credit spread, even though you've been trading bull call debit spreads. Entirely up to the investor. This tool here, the spread chain tool, just makes it much easier to do the comparison so you see right away what you're getting, what your best return is for essentially this trade with the same structure, parity trade with the same strikes that you're planning on your bull call spread. All right, so that's the spread chain, and of course up here at the top there's a little help video you can click on. It goes more in depth through using the spread chain tool, how to use it, and more. So So that's going to wrap up our section on Earl's questions related to structure of a synthetic collar. We looked at the standard long collar structure, substituted the stock for buying a call and selling a put to create the synthetic. We saw some of the pros and cons of that, and we also took a look at the parity trades we might consider a bull put credit spread or a bull call debit spread. That, of course, led us to the discussion of why do investors seem to like credit spreads, and options educators seem to teach more credit spreads than debit spreads. We reviewed our 4 ideas as to why that might be the case. And then, of course, we looked at the spread chain tool to allow investors to quickly analyze the parity between a bull put credit and a bull call debit, as well as a bear call credit to a bear put debit. But of course, I want to remind everyone that this material are my thoughts on Earl's questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed in this webinar should not be taken as direct trading suggestions. Options do involve risk. You'd have to decide which strategy and which structure best suits your needs, but it may not be suitable for all investors. Now, of course, if you wanted to check out that spread chain tool, or even check out some of the webinars that we have on the site related to credit versus debit spreads, plus many more, remember, just go to PowerOp.com, put in your first name, last name, and email address, start your 14-day free trial. No credit card is required. After that, the subscriptions start at $45 per month. We do offer levels of service that include delayed data, historical backtesting data, where the options data goes back to April of 2006, a real-time service, and then everything included in the premium service, real-time and all the history plus the API. You want other free education, of course, you can see other education at blog.powerop.com. Check out the webinars page and also the help videos on the various tools. You can always visit us on YouTube. And of course, if you think of any questions at any time for your options investing strategies, just send me an email anytime to support@powerop.com or support@radioactivetrading.com. You can also call us at market hours at 302-992-7971. Of course, you trial members and subscribers can schedule a coaching session at any time. And we'll see you for the next video. Take care, folks.